Hello there, Mr. Mesh here. I hope you're doing well. Mr. Mesh is good as always, alive and kicking. This is the third part to our 5-part series on Keynesian models. In the first part, we introduced the Keynesian model with a very simple model, but we introduced so many terms that you have to understand. And then in the second part, we spoke about the government, but there were no taxes in that model. The idea is to build from one concept to another so that you don't get overwhelmed. In this third part, again, we have a government, but we're going to introduce taxes. All right. So our aggregate expenditure, always remember this, it comes from 4 sectors of the economy: the households, consumption; the firms, investment; the government spending; and the foreign sector, which is net exports minus imports. But we are still on 3 sectors. Our economy is on autarky. It's a closed economy. So this part, for now, we are going to ignore. And we deal with these 3 sectors. What is different between the previous section and this one is that we have introduced taxes. We are going to introduce tax into this model. So the consumption function is going to change a little bit. Our consumption is still autonomous consumption. So this is going to be our autonomous consumption. And again, we add the induced consumption, where firstly, we put the marginal propensity to consume, which is multiplied by our income. But we consider this to be disposable income, YD. Disposable income means that you're going to take the income that you get as it is and subtract a portion of your income, which is taxed, let's say with a tax rate T times Y. For instance, e.g., if the tax rate is 10%, for example, what it means is that if you're getting paid $1,000, your disposable income is that income of $1,000 minus 10% of that $1,000, which is equals to 1,000 minus 100. You end up with a disposable income of 900. This is the money that you have at your disposal. And therefore, if you factor out Y here, your disposable income is 1 minus T times Y. All right. So what we're going to do here is to substitute this where the disposable income is. We remove it and we put this because this is equal to the disposable income. So your consumption function is the autonomous consumption plus the marginal propensity to consume, the small c, times the disposable income, which we said is given by 1 minus the tax rate times Y. This is our consumption function. We then take the consumption function here into the total spending function. This consumption function, we put it here. So your total spending is this consumption, which is autonomous consumption, induced consumption, which now has this tax in it. Then we add the rest of the autonomous variables, which is autonomous investment and autonomous government expenditure. We put all the Y's together. Remember, in equilibrium, the total spending, aggregate expenditure, is equal to the level of income. We substitute here. We remove this A, we put income. This is equal to autonomous consumption plus induced consumption plus investments plus government spending. We take this Y to the other side. So we have Y becomes a minus, right? Minus marginal propensity to consume, 1 minus the tax rate times Y equals to all the autonomous. In this case, it's just investments, autonomous consumption, government expenditure. We factor out our Y. If we factor out our Y here, it means here it becomes a 1 because the coefficient is 1. This coefficient is C1 minus t, and this whole thing is equal to total autonomous expenditure. So if we divide both sides by this, we are going to have our equilibrium level of income being equal to 1 over this function here, 1 over 1 minus c, 1 minus t, multiplied by autonomous expenditure, total autonomous expenditure. Right? If you got lost somewhere, please pause this video, go back, redo it. If you have any questions, don't hesitate. Send me a message on WhatsApp, send me an email. Let's talk about it, and then I will guide you accordingly. All right, so let's continue here. We have established that the equilibrium level of income from the previous slide is given by 1 minus 1 divided by 1 minus the marginal propensity to consume, multiplied by 1 minus the tax rate, times the total autonomous expenditure, which is autonomous consumption, plus investments, which are autonomous in our model, plus government expenditure, which is autonomous in our model. So in this case, this whole thing here, let me put red for danger here. This here is our multiplier, and this here is the total autonomous expending. So always the equilibrium level of income is given by the multiplier times the total autonomous expenditure. All right. So one thing I want you to remember about the multiplier. Remember, I said, so it's one of those things that helped me as when I was still learning these models to remember. If I forgot this formula, because you can easily forget, you put a plus instead of a minus or something. I don't know what happens in the exam. But what you must remember is that for the multiplier alpha, it's always 1 over the withdrawals. It's always 1 over the withdrawals. Your withdrawals are the same as the leakages. Okay, it's 1 over the withdrawals. So I would say the multiplier is given by 1 over the marginal propensity to withdraw. This is what I would do. With the sectors that we have, the 3 sectors that we have, the withdrawals in this, our withdrawals are your savings. Savings are withdrawals. So we use the marginal propensity to save. And taxes are the withdrawals. So we use the marginal rate of taxation. Okay, so we add these two to get the multiplier. We said our multiplier is 1 over 1 minus c, 1 minus t. But I am putting it to you that you can just simply get the multiplier by adding 1 divided by the marginal propensity to save plus the marginal rate of taxation. What is this? Let me show you. The denominator, just going to write the denominator. The denominator is 1 minus marginal propensity to consume, 1 minus the tax rate. If you expand this part here, you're going to have 1 minus c here, then a positive and a negative, and the negative gives you a plus. The marginal propensity to consume times the tax rate. So 1 minus c, this part we know is the marginal propensity to save. This marginal propensity to consume times the tax rate is what I'm referring to as the marginal rate of taxation. So instead of, so our multiplier would then be 1 over 1 minus c, 1 minus t, which is the same as 1 over 1 minus c. This is our s plus c times t, which is 1 over the marginal propensity to save plus the marginal rate of taxation. But don't just use the tax rate here. Remember, the marginal rate of taxation is the marginal propensity to consume. So it's the marginal propensity to save plus the marginal propensity to consume times the tax rate. So this is our multiplier. This is our multiplier. This is our multiplier. All right. So let's do an example. I'll show you what I mean here. And the problem is you might forget to put this. If you just say S plus T, your answer is wrong. You have to multiply the tax by the marginal propensity to consume. All right, let's do an example here. Let's do an example here. I'm going to go back to the white color. Okay. First part. So you're given a closed economy, which means it's still in autarky. There's no foreign sector. And then autonomous consumption, investments, government, which are all autonomous, and you're given the marginal propensity to consume and the tax rate. So when they say calculate the multiplier, let's do it using the two ways, right? The multiplier is given by 1 over 1 minus C, 1 minus T. Okay. The marginal propensity to consume, so it's 1 divided by 1 minus, the marginal propensity to consume is this one, 0.65. Open bracket, 1 minus the marginal tax rate, the tax rate, not marginal, the tax rate, it's 25%, 0.25. So your multiplier is going to be 1 over 1 minus 0.65 multiplied by 0.75, which is equal to 1 divided by 1 minus 0.65 times 0.75, it's 0.4875, which means your multiplier is 1 over, so 1 minus 0.4875 is 0.5125. 0.5125. Then if you divide these two, you must get to 2 decimal places. Your multiplier is 1.95. And this is actually a bit longer. This is the way to do it. But if you can remember this formula where you just take the marginal propensity to save and you add the marginal rate of taxation, what you do is you subtract here. The marginal propensity to save is 1 minus marginal propensity to consume, right? Which means you're going to have 1 over 0.35. To that, you're going to add the tax rate. So you take the marginal propensity to consume as it is, 0.65. Then you multiply by the tax rate, 0.25. Like this. And then put these numbers in your calculator very quickly. It's 0.35 plus 0.65 times 0.25. This is 0.1625. If you add the two, you get 1 over 0.5125. So your alpha has to be 1.95 to 2 decimal places. So this is correct. It's the same answer. Use the formula that you are comfortable with. Don't stress. Whatever you are comfortable with, use that one. Whatever works for you. This worked for me, but it's me. This could work for you better. You use that. That's the multiplier. The equilibrium level of income is easy. Once we have the multiplier, to get the equilibrium level of income, you just take your multiplier and you multiply by the total autonomous expenditure. All right, since we don't have a lot of space here, what I'm going to do, I'm going to do this on the next page, but take down the numbers for the autonomous consumption, the autonomous investments, and the government spending, which is 40. So these are the 3 numbers that you're going to need them. All right, So I'm going to scroll to the next page. You can always come back. Autonomous consumption is 35 million, investment spending 59, government spending 40. Therefore, your equilibrium level of income is going to be the multiplier times total autonomous spending, which is 1,95. That is our multiplier. Total autonomous expenditure is the autonomous consumption plus the investments, which are autonomous, plus the expenditure by government, which is this. Okay. And this is equal to 1,95 times, you add 35 and 59 and 40, you get 134, and then you multiply by 1,95, you should get 261,3, which is the equilibrium level of income. So I hope you managed to get this number when you put these numbers into your calculator. And then there's another part of the question, part 3. I'm going to scroll up so that you can see. Part 3 is asking, in equilibrium, whether or not there's a budget deficit or a surplus. Is there a budget deficit or a surplus? All right. So what you need to do, you have to get the budget, right? You look at the money coming in. And the money, this is taxes, money coming in. Money going out is government expenditure. You consider this. If your answer to this is a positive, it means more money is coming in than money going out. It's a surplus. If this is a negative, it means there's more money going out than money coming in. It's a deficit. Okay. If it's 0, the budget is balanced. All right. The amount of money collected as taxes is equal to amount of money collected as taxes is 25% of the income, 261,3. So 261,3 times 25%, a quarter of this, it's 65.325. And then our government expenditure is 40 here. It's given. Government expenditure is 40. So we go here, we then say 65,325 minus 40. We have 65,325 minus 40. We have 25.325. What this means is that this is a positive number. So this government has a surplus on its budget. If you don't understand anything, pause the video, rewind, go back. Alternatively, reach out to us on WhatsApp. You can email this. This is my personal email account. This is the company email, Mash Fintech. And then I can assist you further. But in the meantime, Mr. Mash is out. Enjoy economics.